If you want to master lease accounting for the FAR exam, then you need to know how to apply the theory to solving the practice questions. So in this video, we're going to go through two standard lease questions. The first one is going to be moderate level difficulty and focused on interest expense. And then the second question is going to be more advanced and focused on guarantee residual value. So let's jump into the first question. So we always start out a question by reading the last sentence first. What amount should Steam report as interest expense at the end of the first year of the lease? Then we read through the question to look for the details. Steam co-acquired equipment under a finance lease for 6 years. Lease payments were $60,000 payable annually at year end. That means that this is an ordinary annuity. The interest rate was 5% with an annuity factor for 6 years, right here. The present value of the payments was equal to the fair market value of the equipment. So the question already tells us it's a finance lease, but we also know that if the present value is more than 90% of the fair market value, then it would also be a finance lease. So now let's think about the initial journal entry for this lease. Our initial entry is going to be a debit to right of use asset and a credit to lease liability for the present value of the lease payments. The lease payment is $60,000 and the annuity factor is 5.0757. Therefore, this is the initial entry for the lease. And the question is asking about the interest expense. So interest expense is equal to the carrying value of the lease liability times the interest rate. So in this case, it's going to be $304,542 times 5%. And that is our interest expense. This is how much our lease liability is increasing for the year, because we're trying to reverse out the present value calculation of the initial present value of the lease liability. And then we're also making this payment of $60,000, which decreases the lease liability. So the correct answer here is simply $15,227. But if we want to take this question a step farther and ask what the carrying value is at the end of the year, it starts out at $304,542. It increases by this interest expense, and then it decreases by the lease liability cash payment. So then the ending carrying value is $259,769. So then if it asks about the interest expense for the end of the second year, we'd simply take this carrying value and multiply it by the 5% interest rate. So now let's take a look at the second practice question that focuses on guarantee residual value. We start with the last sentence again. Babson's recorded lease liability immediately after the first required payment should be what amount? So then we go through this question and we see that Babson leased 2 automobiles for executive use. The lease requires Babson to make 5 annual payments of $13,000 beginning right away. So this is an annuity due because the payments are at the beginning of the year. At the end of the lease term, December 31st, year 5, Babson guarantees the residual value of the automobiles will total $12,000, and the expected residual value at the time will be $2,000. What this means is that they expect the vehicle to be worth $2,000, but Babson, the lessee, guarantees that it must be worth at least $12,000. This means that Babson is required to pay this extra $10,000 to the lessor. So the $10,000 is the undiscounted amount. It's a lump sum at the end of the lease. So we need to find the present value of this lump sum. So we're going to use this 0.65 times that lump sum to find that the present value of the guarantee residual value is $6,500. So it's the $10,000 difference and then times the present value factor. So that's just the present value of the guarantee residual value. Now we need to think about the present value of the lease payments. So the payments are $13,000, and then we need to use the annuity due factor because the payments are being made right at the beginning of the year. So we take this 4.24 times the $13,000 payment to get $55,120. So then if we think about the journal entries for this lease, the initial entries for this present value of $61,620. So that is the debit to right of use asset and the credit to lease liability. And then the payment of $13,000 is made right away. In other words, no time has passed, so you're not going to have any interest expense. You simply decrease the lease liability by $13,000. So your lease liability after the first payment is the initial carrying value of $61,620 minus the $13,000 payment. So the correct answer is 48,620. So I hope that going through these practice questions has helped you to better understand lease accounting. Thanks for watching.